The financial and economic landscape as we head towards the end of 2024 continues to be shaped by a confluence of factors that have had a profound impact on the markets for gold and silver, two of the most sought-after precious metals in times of uncertainty. These metals, known for their historical status as stores of value and safe haven assets, have found renewed interest among investors amid escalating fears of prolonged inflation, ongoing geopolitical conflicts, and an overall environment of heightened economic instability. Gold, often referred to as the ultimate hedge, has managed to preserve its luster due to its unique properties. It is not only a tangible asset with intrinsic value, but also one that is unencumbered by the liabilities that often plague fiat currencies. The Federal Reserve, along with other central banks worldwide, has undertaken one of the most aggressive tightening cycles in decades, raising interest rates to combat inflation levels that have reached multi-decade highs. Despite these efforts, inflationary pressures remain pervasive, stemming from factors such as persistent supply chain disruptions caused by the COVID-19 pandemic, labor market imbalances, and the ongoing impact of Russia's invasion of Ukraine, which has contributed to substantial volatility in energy and commodity prices. The war in Ukraine has exacerbated existing tensions, disrupting the flow of critical resources such as oil, natural gas, and grain, and has forced Europe to reconsider its energy policies, pivoting towards more diversified sources of energy and increasing the push for renewable alternatives, which inadvertently impacts the demand for metals like silver due to its applications in solar technology. This evolving geopolitical landscape, coupled with concerns about a possible escalation of conflicts in other regions, has reinforced the appeal of gold as a hedge against political and economic instability, driving demand from both retail and institutional investors. Central banks, particularly in emerging markets like China, Russia, Turkey, and India, have accelerated their accumulation of gold reserves as part of a broader strategy to diversify away from the US dollar and reduce reliance on Western financial systems. This trend has been influenced by fears of economic sanctions and the increasing weaponization of the dollar in global diplomacy, leading many countries to seek alternatives that can provide a safeguard against such risks. Gold's appeal lies in its universal recognition as a form of money that holds value independently of any single nation's monetary policy, making it a vital component of reserve portfolios, especially during times of global financial stress. This shift is evident in the record levels of central bank purchases seen over the past few years, with several countries now holding a significant portion of their reserves in gold to mitigate risks associated with currency devaluation and inflation. In the retail investment space, demand for gold in the form of bars and coins has surged, particularly among investors who are looking to protect their wealth against the backdrop of negative real interest rates, where the returns on traditional fixed income securities fail to keep pace with inflation. The appeal of physical gold as opposed to paper gold or derivatives lies in its tangibility and the perception of safety it offers, especially during periods of heightened market volatility. Gold-backed exchange-traded funds, ETFs, have also seen substantial inflows, highlighting the increased interest from both individual and institutional investors seeking exposure to the yellow metal as a hedge against broader market downturns and systemic risks. On the technical side, the price of gold has shown strong resilience, maintaining critical support levels around $1,900 per ounce, while facing resistance near the $2,100 mark, which, if breached, could signal a potential breakout and pave the way for a rally towards $2,300 or even higher. Technical analysts have pointed to a bullish formation in gold's price charts, suggesting that sustained buying pressure could lead to a significant upward movement, particularly if macroeconomic conditions continue to deteriorate or if there is an unexpected escalation in geopolitical tensions. The ongoing demand from central banks, coupled with strong retail investment interest, provides a robust foundation for gold's price, while any sign of dovish pivots in central bank policies, such as pauses or cuts in interest rates, would likely act as a further catalyst for price gains. Moreover, the weakening US dollar, influenced by concerns over the sustainability of the U.S. government's fiscal policies and mounting national debt, adds to the bullish case for gold, as a weaker dollar generally enhances the appeal of dollar-denominated assets like gold to foreign investors. The relationship between gold prices and the U.S. dollar is often inverse, meaning that when the dollar loses value, gold tends to rise, driven by its status as a global reserve asset that holds intrinsic value beyond the fluctuations of any single currency. Meanwhile, silver, often referred to as the poor man's gold, plays a dual role in the financial markets as both a precious metal and an industrial commodity, making its price movements somewhat distinct, yet often correlated with those of gold. The industrial demand for silver has been buoyed by the rapid expansion of renewable energy technologies, particularly solar power, where silver is a key component in photovoltaic (PV) cells. The global push towards achieving net zero carbon emissions by mid-century has accelerated investments in solar energy infrastructure, driving substantial demand for silver. Countries such as China, the United States, and members of the European Union have implemented ambitious climate policies, investing billions into renewable energy projects that heavily rely on silver, not only for its conductive properties, but also for its role in enhancing the efficiency of solar panels. Additionally, the rise of electric vehicles, EVs, which require significant amounts of silver for their electronic systems, batteries, and power management components, has added another layer of demand, reinforcing silver's importance as a critical material in the ongoing shift towards sustainable technologies. This increased industrial demand, combined with supply constraints, has contributed to tighter market conditions for silver, with analysts forecasting potential shortages as mining production struggles to keep pace with rising consumption needs. Many of the world's largest silver mines, located in countries like Mexico, Peru, and Bolivia, face challenges such as declining ore grades, regulatory pressures, and political instability, which have limited the ability of producers to expand output. From an investment perspective, silver's appeal is multifaceted. While it shares many of the same safe haven characteristics as gold, its lower price point and greater volatility make it an attractive option for investors seeking higher potential returns, albeit with increased risk. Retail investors, in particular, have shown a strong appetite for physical silver in the form of coins and bars, driven by the metal's historical role as a hedge against inflation and its perceived undervaluation relative to gold. The gold-to-silver ratio, a popular metric used by investors to gauge the relative value of the two metals, has fluctuated significantly over the past few years, often reaching historically high levels, which some interpret as a sign that silver is undervalued and poised for a potential rally. If industrial demand continues to outstrip supply, this could lead to a tightening of the physical market for silver, pushing prices higher and potentially narrowing the gold-to-silver ratio. Additionally, silver-backed ETFs have witnessed strong inflows, reflecting increased investor interest and confidence in the metal's potential for price appreciation, especially as inflationary pressures persist and economic uncertainties remain elevated. Broader market dynamics have also played a crucial role in shaping the outlook for both gold and silver. Stock markets have experienced significant volatility in 2023 and 2024, fueled by concerns over stretched valuations, slowing corporate earnings, and the impact of higher interest rates on economic growth. This environment has prompted many investors to seek safer assets, with precious metals standing out as preferred choices due to their historical performance during periods of market turbulence. At the same time, the bond market has faced headwinds, as rising yields have made fixed income investments less attractive, particularly when adjusted for inflation. The concept of negative real yields, where the inflation rate exceeds the nominal yield on bonds, has further underscored the appeal of gold and silver as alternative stores of value, offering protection against the erosion of purchasing power. Additionally, the recent turmoil in the cryptocurrency market, marked by extreme price swings and increasing regulatory scrutiny, has led some investors to reconsider their allocations to digital assets, favoring the relative stability and long-standing value proposition of traditional safe haven investments like gold and silver. This shift in sentiment highlights a broader trend of risk aversion among investors, driven by fears of potential asset bubbles and the desire for more reliable hedges against economic uncertainty. Looking ahead, the macroeconomic environment is expected to remain challenging, with several key risks that could influence the demand for gold and silver. Chief among these are the prospects of a global recession, which many economists believe is increasingly likely given the current trajectory of monetary policy tightening and its dampening effect on economic activity. Rising interest rates, while intended to curb inflation, also increase the cost of borrowing for consumers and businesses, potentially leading to a slowdown in spending and investment, which could weigh on economic growth. At the same time, the risk of a prolonged period of stagflation, characterized by stagnant growth and persistent inflation, cannot be ruled out, especially if supply-side constraints continue to pressure prices while economic output remains subdued. In such a scenario, Gold and silver are likely to see strong demand as investors seek to protect their portfolios from the dual threats of inflation and recession. Financial advisors and analysts continue to recommend that investors consider strategic allocations to precious metals, typically suggesting a portfolio exposure of 10-20% to provide a robust hedge against macroeconomic risks and enhance diversification. The consensus among market experts is that the long-term outlook for gold and silver remains favorable, supported by solid demand fundamentals, ongoing central bank purchases, and a heightened awareness of the metal's value as part of a balanced investment strategy. As the global economy navigates an increasingly complex and uncertain landscape, gold and silver are well-positioned to deliver stability, hedge against inflationary pressures, and offer potential for capital appreciation, reaffirming their enduring status as reliable stores of value in an era marked by unprecedented economic challenges.